We're in the middle of an inflationary environment. Now, I don't think that news is going to surprise anyone, but investors have been asking, in this type of time period, which companies or sector of stocks have the ability to outperform and continue to succeed despite the inflationary pressures? And that's what we're going to be diving into today. So one cohort of these companies that investors and analysts have been looking towards is companies with pricing power. Warren Buffett said it himself when he stated that the single most important decision in evaluating a business is pricing power. That in itself is high praise from one of the best investors of all time. But what is pricing power at its core? In essence, it's the effect of a change in a firm's product price on demand. Obviously, this is intertwined with the concept of price elasticity. As prices rise, what is the effect on demand? Is a company able to continue to sell a significant amount of product? Or is there a range of substitutes available, and will it see a significant downgrade in terms of demand? Of course, you might be wondering, well, what defines pricing power? There's a range of different factors that contribute into it. Obviously, a company's brand, the actual product or service that it's offering, but it all really distills down into this one concept of scarcity. So how rare or non-rare is a product it's offering? Is there substitutes available? Obviously, if you have a differentiated product, potentially in a niche service industry, if you have the ability, obviously, to be operating in a market where you control the lion's share of the market share, maybe you're in a monopoly or a duopoly or that type of structure, all of these types of setups mean that you likely have more pricing power versus being in a commoditized industry where, say, you're selling something like toilet paper or a chair, where there's a range of different substitutes, and as your prices move higher, customers will look to alternatives to be able to satisfy their needs and wants. Okay, and so with that contextual backdrop, you might be thinking, pricing power, as a concept, that makes sense. Obviously, in this inflationary environment, we have rising cost pressures. Obviously, supply chain bottlenecks mean the input costs for products are going higher. We have a labor shortage as well, which means that there's rising wages too. But why is there such an importance and focus on pricing power? This is a fascinating study that UBS conducted, and it has to center around a range of S&P 1,500 companies and those with strong pricing power versus those with weak pricing power. What's fascinating about this is it's overlaid by the US inflation rate over a 6-month annualized period. This runs from January 2010, so the recovery out of the GFC, through to 2021. And what we can see here is that as the inflation rate rises, obviously we're at an inflation rate of 8 to 9% at the moment over in the US side. But when we get above 3%, so that 2 to 3% band is where the central banks want us to sit. When we're above that level, we can see that companies with pricing power have outsized returns and outperform those relative to the weaker ones. And this effect is amplified the higher the inflation rate. And obviously this all ties into the effect that as you have rising costs, if you're not able to continue to pass on those prices onto consumers, then that's ultimately going to affect your profitability. And so what's fascinating about this is they went one step further into this study. And we can see here, the pricing power score of S&P 1,500 companies, when it's segmented into sectors. So companies with strong pricing power, consumer staples, makes sense. Consumers are going to need their staples, whether they're more or less expensive, just to continue to be able to survive. Communication services at the core as well. But then IT and consumer discretionary. And we see some of these companies, these mega cap technology names with real pricing power that are able to continue to pass these on, particularly because a lot of their software is embedded in the day-to-day uses of either enterprises or the everyday consumers. On the consumer discretionary side, just in this recent earnings season, we saw companies like Coca-Cola, Pepsi, McDonald's highlight the fact that they were able to pass on rising prices to consumers and they had relatively resolute earnings. But earnings season is always a fascinating time to be able to tell how are companies performing. But there's also one more metric as well that we can use to get an understanding about how pricing power is flowing through. Before we dive into that, if you've enjoyed the video, like, subscribe, turn your bell notifications on. We've just dropped this second channel, but I'd also love to know your thoughts. So drop in a comment below what you think about this whole discussion. And so one other metric that we can use to assess a company's ability to pass through these rising cost pressures and its effect on profitability is the Jaws ratio. If you're not familiar with the Jaws ratio, it's the extent that the income growth rate exceeds its expenses growth rate. Obviously, it gives us an insight into profitability, but it's just as important during this period when expenses are continuing to rise because we get this understanding about how a company's going. Are they able to maintain their profitability? Obviously, those companies that we really want to see with strong pricing power may be able to continue to grow into more positive jaws during this period. And this is a metric that's going to be very useful over this upcoming 6, 12, 18, 24 months to help to separate our understanding about those companies that maybe are going to struggle versus those that are able to really continue to expand and really utilize their operating leverage to expand their profitability. I'd love to know your thoughts. Drop in a comment below. Hope you enjoyed this video. Check out another one, which we'll have a link to now. Thanks for joining us. For now, stay well and happy investing.